and welcome to Fidelity Connects. I'm Pamela Ritchie. When we think about factors, 2024 was an exceptional year for momentum. AI driven names, helped fuel this one-way train ticket. But as 2025 unfolds with an air of uncertainty in the markets, our next guest says there is another factor kind of stirring the pot. Joining me now to discuss which factors are shaping today's markets and why is Fidelity Head of Quantitative Index Solutions, Bobby Barnes. Welcome, Bobby. Great to see you. How are you doing?
Hi, Pamela. Thanks for having me. I'm doing well.
Yeah, happy Friday to you. Great to have you here. And we'll throw open the doors to everyone's questions. They can send those in for you over the next half hour or so. Let's begin from a factor perspective on what you are looking at for Fidelity each day. What do you do when you don't really know where you are? I mean, that's business cycle, that's policy. There's a lot of reasons why we don't exactly know where we are. How do you start measuring?
It's great questions. And so I'll start with the first part of it, which is, if you don't have a view on cycle, et cetera, how do you think about utilizing factors? And that's one of the, I think, beauties of factors is that they tend to work over time. And if you own a collection of them, and you can do something just as simple as just equally weighting them, then that will kind of give you a reasonable portfolio if you're kind of agnostic, as I mentioned, to where you are in the cycle and economic activity, et cetera. That being said, obviously, I always have a view and looking at a lot of things to try to predict, particularly where economic activity is likely to head, and that informs the prescription that I would give for factors that I would overweight versus underweight.
So give us a sense of sort of the cards that you're holding in terms of what you're looking at. So certainly what went well over the last little while, the rate story that fits in there, we've got the policy overlay. What are you sort of using to form, your view at this point? What are the big chunks?
So the big chunks, I'll start with the one that's, I guess it was very topical, was the cost of money, right? And so the thesis there is that when money becomes more expensive, it slows things down. And as it gets cheaper, it speeds things up, right? You get more economic activity. And so it's instructive to look back over time. So we went through the inflationary shock of 22 and 23 and had the rate hikes. So the cost of money got more expensive to slow things down and thereby slow inflation. During that time, let's take 23, for example, the best performing factors were momentum and quality. And that's consistent with late cycle. Fast forward to last year, as you mentioned at the top of the call, the best performing factor by far was momentum. Second best was also quality. And here again, that's consistent with the market environment and what typically works in a growing environment, but slowing growth, which is how I characterize where we were. Ironically, if you had spoken to me at the beginning of this year, only 2 months ago, my prescription would have been the same based off of the things I'm looking at. From a cost of money perspective, we did have some green shoots in that we did get a couple of rate cuts towards the end of the last year, but more importantly, the headwinds of really digesting the rate hikes, we had passed the time required to digest that fully in the market, and so that was no longer going to be a headwind. And along with that, we actually did see somewhat positive or rising ISM, which is my most favorite indicator of economic activity. So these are all great things. And the punchline I would have given you 2 months ago is that I would expect more of the same for 2025. I would have prescribed momentum and quality as I didn't see a reason for that to really change. But ironically, 4 weeks into this new administration, I've got a few updated thoughts in that regard.
So interesting. Okay, can we begin with, there is policy uncertainty.
Yes.
Tell us a little bit about how you handle that, because there are announcements coming fast and furious. We all know this. There's a little bit of a chaos. It may be a strategy. We don't know, but it is certainly hard for investors to sort of, and what do? Do you stay the course to an extent, or where are you shifting, maybe even at the margin?
Yeah, so let me share my thoughts there because there's kind of a lot to unpack. So there's a lot of policy uncertainty, and it certainly makes it hard as an investor because we never are we going to get the tariffs? Are we not? Like it's like no one knows. And then the expiration date passed, and we just kicked the decision down the road, which is what happened a month ago. And and so I actually, rather than think about it from an investment standpoint, I think where I've landed is putting myself in the shoes of corporate directors. Now they have the same, uncertainty, right? But when you think about, okay, what's going to be their behavioral response due to these uncertainties, and I think what's going to happen is they will be very conservative on their investments, whether it be capital expenditures or hiring that next person, adding them to the headcount. Um, and so, because that kind of prepares them for any outcome. And so by doing that, I think that has the bank shot of ultimately leading to directionally less economic activity. And so for that reason, my preferred factor at the top of my list is quality, which is, it's done
Okay.
well for the last 2 years. Like I said, that's still, I think, my highest conviction bet. But where I modified my thinking over the last, call it 8 weeks, based off of the dynamics that we're talking about now, is I'm concerned about momentum. Um, Momentum is kind of just trend following, and I'll borrow from Sir Isaac Newton. So,
Okay.
it's law of physics. When an object is in motion, it will stay in motion unless and until it's acted upon by an exogenous force. And at the beginning of this year, I was thinking, oh, well, it's going to be more of the same, no exogenous forces. But I think some of this uncertainty actually changes that view and makes some of those, particularly because a lot of the momentum names are expensive. I mean, they've outperformed for 2 years now. And so they're kind of priced to perfection. And that is a risk if you have any slowing growth, while still positive growth, that will make those names more susceptible.
Yeah, really interesting. And then the other piece to what you do all the time sort of is the relative side of things, which is partially what you were just talking about there. But whatever is first becomes the worst, and that sort of thesis, and therefore other things step up to become leadership. This is more on a sector side of things, but I mean, we are seeing a rotation, aren't we?
We are seeing a rotation, but what's interesting about this rotation is that it's a rotation that ironically is more of the same. So bear with me, and I'll explain what I mean by that. Last year and the year before, we were in very narrow markets. You only had about 1/3 of all stocks outperform the S&P, as an example. 2/3 underperform. Year to date, you are seeing, just from a participation standpoint, now it's normalized. It's about 50-50. When I look at the number of stocks year to date that have outperformed the index, it's more balanced, and so that's a broadening out. But from a characteristic standpoint, when you say, okay, well, all right, more stocks are outperforming, but what are their characteristics? That's where it's more of the same. Where in 23 and 24. Large caps outperform mid caps, and mid caps outperform small caps. Although we're getting a broadening out year to date, that statement is still true. Large is doing better than mid, and mid's doing better than small. Similar thing with quality. The higher quality stocks are doing better than the lower quality ones. So you're getting a broadening out that still emphasizes the same types of stocks, if that makes sense.
Interesting. So it not necessarily coming down in cap size, for instance, like it's still quality, but it is, as you say, larger versus smaller. Like we're not, small caps have had a rough go trying to get into the market over the last year, even though rates have come down and the cost of capital has a new story now than it did. We're not really seeing that finding footing yet, are we? Or is that something that I mean, do you have a new view on that part of the market, the smaller cap side of some things?
So what's interesting there is that's where I was spending a lot of my time and effort at the beginning of this year, kind of thinking about or trying to calibrate how to think about small caps. And what's happened there is if you kind of go back to the start of our rate cuts last fall, right? The sentiment or narrative at the time was that, as you mentioned, the cost of capital will come down. That'd be better for the small caps, and for that reason, market participants were, some, I was not, but some were bullish on small cap, which I understand that reasoning. Now we're to a point now where I think the narrative has changed a bit, because rates will come down, but rates were coming down for a different reason before. There was policy normalization. We hiked it to combat inflation. We appear to have it under control. That's why rates were coming down then. Now, I think we're actually entering in an environment where rates will come down because of a growth scare. which if there's going to be slower growth, less growth, that's not a fertile environment for small cap. And then kind of getting back to policy, small caps, they're the thing about small caps is that they're lower quality. They don't have, for example, as many suppliers. And so if all of a sudden they're one supplier, wherever they are in the globe, it has a tariff, they're not as nimble. They don't have the ability to, okay, no problem. I'll have my stuff made over in India or Venezuela. Like they can't be as nimble as the larger, more global diversified companies can be. And so I think that's what's causing the weakness we see year to date in small.
Okay, so let's dig right into the growth story there. And it goes back to your Sir Isaac Newton question as well. But we are seeing, I mean, softer economic data last week caused a sell-off last week. It also caused much of what we saw this week. There were lots of earnings to put into the mix. And just not the same kind of power of the sort of buy the dip coming back in. Again, it's also coming down from all-time highs. So you don't want to get too overexcited about this, but put that all in perspective for us. What we've seen in slowing economic growth, less muted excitement about pretty powerful earnings. What does that tell you?
There's a couple of things to say there. So first of all, we're incredibly early. We just finished reporting season. Like 90% of the large caps have reported. There's still some smalls to trickle in, but reporting season was great. And not only was it great, but for those high flying momentum names, particularly the AI ones, they had great reports. And then
not enough. It's not enough.
And then, you referenced some of the economic reports that we've received, over the last couple of weeks or so. A lot of that's water under the bridge. I mean, those, they were maybe indicative of some slowing, but, honestly, it's the future discounting that's causing the what we're seeing in the stock prices themselves.
The forecasting, or like getting your estimates, because it's hard to know.
Yeah. And so I don't think, so I guess where I'm going with this is I don't think that any of the economic reports we've seen in just the first 2 months of this year are really reflecting any of the things that we're talking about, which are more forward looking.
Okay. So what do we do with that then? When we're sort of thinking about, you're never exactly right in forecasting, but it gives you a plan to at least work off.
Yes.
What do we do in light of that being actually very difficult to do right now?
Yes. So where I land there is, as I mentioned, I evolved my thinking a bit from the start of the year. My prescription at that time would have been a 50-50 blend of quality and momentum, which is what worked the best over the last 2 years. And I was extrapolating that forward. With my updated thoughts and incorporating a lot of what we're talking about now, I would modify that a bit, and I'll explain the rationale in a moment here. But I would still allocate 50% of your capital to a quality strategy. I'm not really ready to sell momentum yet, and so I'm actually still inclined to have some momentum exposure, because those stocks, while they are expensive, do have exposure to secular trends and earnings growth. But where my updated thinking is, I want to augment the momentum exposure with value. And so there are a couple of reasons why. One, value just it tends to be negatively correlated with momentum anyway. So when momentum goes down or underperforms, usually your value portfolio is outperforming, kind of offsets that. That's number one. But then number two is that just by nature of some of these topical trends, AI and the like, they tend not to be cheap. And so if those names are if you own less of them in a value portfolio, then that'll help offset any particular growth slowdowns or unexpected negative revisions in those names if they need to be discounted. Because again, they're priced to perfection. So if we don't get a perfect next 12 months, then that's where some risk is, and I want to offset that with value. And so really what I'm talking about then is, say, 50% on quality, and then your other 50%, keeping things simple, do 25 in value, 25 in momentum. And that's kind of my prescription.
Fascinating. Okay, well, let's go further into the value story a little bit. This becomes somewhat of the value trade. We already talked about small caps. Sorry, the relative trade. When you're looking at sort of the prescription for where value might fit, I mean, I'll just ask you, what are you taking from the bond market these days? Because there are some interesting moves in the 10-year yield that were, I mean, we were sort of on watch for it to go higher, but it actually has been reasonably stable.
Yes. So the bond market has been interesting to follow. It's been stable to your point. It's declined, and then it also spreads. That's the other thing that just to mention, like when you're looking at particularly the bond spreads as you go from investment grade down to high yield, spreads are very tight. So they're really not pricing in any volatility or risk due to some of the things that we've talked about thus far. That being said, that's when you as a student of the market and you look back historically at times when spreads were very tight and they blew out, it actually can be a contrarian signal. So when things are very tight as they are now, it's kind of like not having insurance. So the best time to buy bonds is actually after the spreads blow out, which they have not done yet.
It's not now. Yeah.
Just not now, right?
Okay, that's really interesting. The question rolling in here, is Bobby involved in the Fidelity all-in-one ETF funds? Yes, go ahead.
So yes, absolutely. A lot of the componentry in the all-in-ones come from my team. And actually another point that I would add to that, to kind of to your question at the top of the call about, what should an investor do if they don't have a view on the cycle and where things are going to land, et cetera. That's kind of the beauty of the all-in-ones, where they simplify the investment decision for you. Really, the only decision that you really need to make is ascertaining where you are in terms of your risk appetite. And we got three choices: conservative, growth, or core. And so where you are on that spectrum, you kind of choose one of those three, and then we've already kind of come up with the allocation across asset classes and within asset classes where a lot of my factor products reside. And then you just kind of weather that, have that portfolio weather it for you.
Really, really interesting. So if, for instance, certain things are not priced into this market, it actually feels like certain things are being discounted right now. And even you and I spoke briefly on Monday, and even since Monday, probably more things have been discounted. But I do want to ask you what is maybe not priced into the market and therefore is a risk. And it may come back to the all-in-ones where you just sort of spread out the risk. But when you look at these markets, what do you think is not really priced in?
Well, great question. And I'll first, before answering it, because the concept of something being priced in is interesting in that, because people say it all the time, but no one really actually presses you. Like, how do you actually know?
How do you know? Yeah.
Yeah. So let me share for the audience how I go about trying to know or ascertain what's priced in versus what's not. My approach is by looking at the earnings estimates. And so if you kind of rewind back the clock to a point where a lot of these discussion items weren't being talked about, you had certain earnings estimates for the S&P and the TSX and et cetera. And then I kind of do it before and after. It's like, okay, at that point, we weren't talking about it. And market participants were estimating S&P earnings to be, I think $280, I think might be the number for 2025. And then say, okay, well, what are they estimating now? And any change, particularly if it's, revised down, then you could actually assume that, okay, they're baking in maybe some tariff impact of some sort. So that's my framework. And so that being said, when I do that analysis thus far, I don't see any of these risks being baked into the forward estimates right now. And I think I understand why, because it's hard to know when you kind of do the game theory of, okay, will we get them? Won't we get them? It's too early to tell. Because the last time U.S. kind of went to bat with Canada a month ago, we postponed it a month, and now March 4th, I think, is a new date. Who knows? Will we get them? Will we not? Is it just a negotiation tactic? And so I think for that reason, a lot of market participants and like analysts in particular have to sit on their hands. You don't want to model something only to pull it back out again. And so I think what that means is, it's going to be easier, I think, to have a forward-looking forecast in the back half of this year, because I think some of that dust will actually settle. It'll crystallize more clearly than it is today.
Interesting. And when you go from, for instance, the so-called Trump bump that was in the equity markets, and there was much discussion about whether you sort of position into that or not, and that again was also something that people sort of said, steady as she goes. But from where that saw the equity markets to where we see them now, there was actually great certainty, it seemed, in investors' minds shortly after the election. And now it is quite different. I wonder if you can just sort of comment on how that is manifesting itself a little bit in the markets you're watching.
So that's an interesting one as well. So we had the Trump bump where, last November, everyone got excited about the policies and it being pro-growth, as he likes to say, as the administration likes to say. And there are four components to it: tariffs, immigration, then you had taxes, and then you had government efficiency. So basically spending, reduce spending, making the government more efficient. And what's interesting about those four pillars is that the administration believes them to be stimulative, all four in some way, in their own ways. Economists, however, on balance, on average, find three out of those four to actually be to actually slow economic activity. And kind of if you keep it simple, right? Like if a tariff is a tax, and if that makes things more expensive, people aren't going to buy more of something because it's more expensive. Like the response is you're going to buy less. And you kind of work through each of the four, you can kind of get to a similar place where, immigration, at least, I don't think it's a big number, but on the margin, there are fewer people who can buy goods and services than less if you kick them out of your country. So that's not a directionally stimulative thing. And same thing with the government spending, where as the government had layoffs in order to get more efficient, those are people who had a job, no longer have one. And so now they need to be more conservative about their spending until they get a new job. And so at least in the interim, that also leads to at least directionally lower economic growth. And so I think that, as you mentioned, the Trump bump in November, but then how that's kind of been given back thus far. I think that's where a lot of people sharpen their pencils to, okay, what does this stuff actually mean? And I think that's how I would explain why there's been that give back thus far.
And I mean, you were mentioning this before in a conversation. Some of this, all of the policy, obviously, if it's policy, it's man-made. You can take it back. It's less of the exogenous shock in terms of it's in someone's hands to moderate it or tweak with it one way or the other. I guess, what do you think markets are signaling to just the overall environment? Like, if there's a pullback, that is a concern about growth, basically.
Yeah. Well, that's also part of what makes the modeling hard. The fact that it's, all this is self-inflicted. Like we could just not do a lot of those things if we wanted to.
That would be nice.
And isn't being forced. And so yeah, I mean, and that's where, it's hard to gameplay it out if when you know that it's almost easier when it's a truly exogenous shock or thing that's happening to you that you have no control over. Whereas, in this scenario where on any given day, it's like, well, I referenced March 4th, like March 4th might become April 4th, or it might go away entirely, but who knows?
But we don't know. Tell me, where does low vol and some of the other factors come into play at this point? I mean, uncertainty can lead to high vol. So where does low vol sort of play a role in where you're looking at things right now?
Yeah, good question. And I know a lot of what I said might seem supportive or prescriptive for low vol. The reason why I'm not there yet, I mean, it is true that slowing growth is usually good for low vol, but low vol really does well when you have contracting growth. So the earnings are actually shrinking. Not growing, but just at a lower level. And I don't yet see us in an environment where in 2025 you actually get earnings contraction. And so that's you have to take a more pessimistic view of a lot of the things that we're talking about and believe, because, if we did get 25% tariffs as an example, that is mutually destructive to both parties.
The earnings would come off. Yeah,
Yeah.
that would be an earnings
Yeah,
story. Yeah.
earnings contraction. Whereas, usually if you have earnings growth and a positive return to the equity market overall, low vol typically doesn't outperform, say, the S&P or the TSX when those indices are up. And so that's why I'm not yet there. I mean, that's more of an end of cycle playbook. I think I'm a little bit more sanguine than that. If I pivot though to, because you're asking me about factors more broadly, as I mentioned, I'm negative on small, but we haven't talked about high dividend. High dividend, I would be supportive with. As I mentioned, my prescription of owning value as an offset to momentum. You can utilize high dividend in a similar way. And so that one, I think, could be either swapped in for your value exposure or added. You could split your value exposure between just, pure value and high dividend to provide those offsets to momentum for the reasons I mentioned earlier.
That's really interesting. So there's the growth story, earnings story, and so on. There's also these huge high flyers where valuation does come in, and you've mentioned that even some of the ones that are high valuation are, the big Mag 7 names. They're still good, very good companies. Their earnings are strong. With that said, though, I wonder if you sort of take valuation into the other side of things where certain things are very cheap, and we're talking about value, but certain things are cheap for reasons sometimes as well. So just kind of enter in the discussion there of a rotation to things that might be more value oriented, but not things that are just not going to move because it's not just a valuation story. Valuation is secondary ultimately to the earnings story.
Yeah, so there's an important understanding to make there. So you just mentioned it, and I'll flesh it out more fully. So one of my first research projects when I got into this business 15 years ago was to...
After being a rocket scientist.
Yes, after being a rocket scientist. I was assigned the task of researching what drives stocks over time. It's kind of a broad, open-ended research question, but the answer was very illuminating, and it won't be a surprise when I say it, but it's earnings growth. Now, the thing about earnings growth is earnings growth is good, but the best thing is earnings revisions. And so what I found was that valuation is a secondary consideration. So if a stock outperforms, the answer to the question of if a stock is going to be outperformed is always driven by earnings revisions. The role that value has to play is that determines by how much. So answer the first one first. Is this stock going to have positive relative earnings revisions? If the answer is yes, then you look at valuation, and that actually will dictate by how much the stock is going to outperform over time. And so, getting back to your earlier question, value is cheap. Small size is actually cheap too. But the reason why I am more positively inclined on value rather than small size, is that at least with large cap value, you're still staying up in market cap. And so you've got a bit more quality exposure, even though you're buying ultimately value stocks. Whereas when you go down in cap to small size, yes, they are cheap, but they have much less quality. And that's how I distinguish between the two and how to think about the valuation of both.
It's really interesting that that was the project that you began with, and that that's what came out of it, the crystallizing effect. If we roll back or rewind to either the end of last year or the beginning of this year, there was a lot of discussion about earnings always have to pull their weight, but they really have to pull their weight right now. And that was a valuation story, wasn't it? I mean, that was because valuations just skyrocketed. And as you mentioned, the earnings story is always first and foremost, but it kind of wasn't for the last couple of years. I mean, valuation is what pulled everything forward.
Well, yes and no. So yes, you are right. You absolutely got multiple expansions.
I want you to correct us here. Yeah.
No, it is. I mean, it is true, but like, if I take last year, for example, there were two drivers. You essentially got paid twice. And so what happened was, in U.S. large caps, dominated by the Mag 7, you had tremendous earnings revisions in the Mag 7 bucket as a group. On top of that, you also had multiple expansion. And so that's why I say that, when you got paid twice. But it is true, to your point, that where we sit now, the multiple expansion we got last year, you're not very likely to get that again. We're the S&P is at a 26 times PE multiple. I don't think it's going to 30. So, that's kind of, at best case, you stay at 26, and then your earnings really have to be the driver of your return.
So what would you leave as just sort of a final thought for those thinking about how factors are going to play their roles within portfolios for investors? Just kind of rewind to some of your opening comments and have a final thought.
So yeah, in closing, what I would say would be to keep a steady hand. Because of a lot of the uncertainties here, you don't want to assume a one particular outcome, place all your chips in that way, and then potentially get whipsawed and have to unwind it. And so the best strategy or course of action, at least for I think the first half, is to kind of stay the course thus far, let things materialize and crystallize a little bit better, and then think about if you want to rotate your portfolio or really tilt your portfolio. I wouldn't really advocate for a full rotation in any event from where we stand right now.
Okay. Bobby Barnes, it is always fascinating to get your views on the markets and how the factor story can slice through some of the stories and make sure they get returns for clients and for investors. All the best. You have a good weekend.
Thank you. You too.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.